Both the Fed and the ECB are facing difficult times. Is the monetary system stuck in a deadlock? And if so, do we have better money? Welcome to the Flossbach von Storch Research Institute. My name is Marius Kleinheyer, and today we have a very special guest with us, Professor Larry White from the George Mason University in the USA. He's a professor of economics and author of the book Competition and Currency on the topic of free banking and private money. Larry was talking about this topic way before it was cool today with the Bitcoin. And today with us is also our director, Professor Gunther Schnabl.
Hello, Marius.
Larry, how political is the Fed today and how political should it be?
Well, should it exist is a more fundamental question, but given that it was created by the U.S. Congress, it's almost inevitably going to be somewhat political. People worry about the degree of independence of the Fed from political forces. I think it's more important for the Fed to have a clear mandate, to have a rule to follow, and to be held accountable to it. But we have seen under the new Trump administration more political pressure, at least more overt political pressure than we had seen in previous years. So Trump is constantly telling the Fed you need to lower interest rates and criticizing Jerome Powell by name. And recently trying to get one of the members of the Board of Governors fired so that he can replace her with his own candidate in order to change the composition that votes, the body that votes on monetary policy. So I would say we've seen an increase in the politics around the Fed, a visible increase in the politics, but it's always there in the background because having been created by Congress, it's going to be a political institution.
The Fed has given itself a 2% inflation rule. How is that working out?
Well, you're right. They gave it to themselves. So under Ben Bernanke, they declared that we have a 2% inflation target. And they've modified the target a couple of times since then, made it clear that when inflation is above target, they're not going to be in a big hurry to bring it back down. Whereas when it's below target, they're going to let inflation run hot a little bit to bring the average back up to 2%. So it's an asymmetric target, and that means it's really not very predictable where the price level is going to be in 3, 4, 5 years. Because we don't know how fast they're going to try to return to 2% when they miss it. And right now, inflation is running about 3%, either if you look at the consumer price index or if you look at the Fed's preferred measure, which is the personal consumption expenditure deflator. They're both running about 3%, not 2%, and yet the Fed has switched from tightening to loosening. So they've cut the interest rate they pay on deposits at the Fed, and they're indicating that they're ready to do more rate cutting in the coming year, which seems strange if they were really devoted to bringing inflation down. Right? They should be continuing to tighten until they've established 2%. They seem to be worried about about unemployment rising and about real output falling. But unemployment has been below normal for a long time, and now it's approaching normal, and the Fed seems to be worried about that.
In Europe, the ECB was designed after the German Bundesbank, and the 2% is even a constitutional goal. But still, we also have the impression it's a political institution today.
Yes, the ECB was created as a political project, as a part of the process of getting a unified Europe. We had a very fruitful currency competition before the introduction of a euro, but it was the goal of the French to create a common currency, a European currency system which was not dominated by the hard currency, the hard German mark. As you rightly said, the ECB was modeled after the German Bundesbank as an independent central bank in the European treaties, but what we finally got is something totally different. There's no overt pressure on the ECB to pursue a certain monetary policy, but the decisions which people are represented in the board of the European Central Bank clearly went into the direction of a soft currency. And now the ECB started in the course of a European financial and debt crisis to buy a lot of government bonds, which the German Central Bank never did. And meanwhile, the main goal of the European Central Bank does not seem to be to preserve price stability, but to contribute to climate policy or to introduce a central bank digital currency, which should not be the decision of a central bank, but which should be a democratic decision made by the parliaments in the European Union.
How much do we today still live in this post-financial crisis world, and the FED and the ECB are still trying to clean up what happened there some 15 years ago?
So the concern over financial stability, which both central banks share, is already a deviation from exclusive focus on price stability. Yeah, the Fed took on enormous new powers, creating all kinds of special lending facilities for different segments of the financial industry, which means that they think it's part of their mission to decide who deserves credit, which financial intermediaries need special help. And that, of course, means less credit for other parts of the system. But this was never part of the Fed's mandate. And they're ready to jump back into action. So after the financial crisis, we had the COVID crisis. And in the pandemic, the Fed went back to creating all kinds of new lending facilities. They even opened up a credit line to municipal governments, which they had sworn for years they would never do. And this creates an environment in which any financial intermediary or any indebted entity, like municipal governments, will come to the Fed and plead for special treatment. And so it's very much politicized the Fed's operations. And yeah, I think we're still in the shadow of that.
And in Europe, it's the same story, but with national states.
Yes, we have a similar dimension. Of course, the ECB also in the course of a European financial and debt crisis created different programs, a corporate debt purchase program, a covered bond purchase program, credit lines for European banks, but also, as I already mentioned, large purchases of government bonds, and more now we have a discussion, the government bonds of which countries should be bought. We have highly indebted countries in the south of the euro area, namely Greece, Italy, Portugal, Spain, and increasingly also France. Germany is less indebted, and we can expect the situation that the ECB will be forced to buy in a preferenced way the bonds of highly indebted euro countries in order to save the euro. So indeed, the euro is highly politicized as well.
You can see this in the balance sheets of both central banks. They expanded enormously in the financial crisis, and the Fed then stopped expanding, but never contracted very much back. They talked about reestablishing a normal balance sheet, but they never got very far, didn't make much progress. Then the COVID crisis happened and the balance sheet ballooned again. And they've been very slow to return to normalcy. So we're in a regime of huge central bank balance sheets and abundant reserves, that have made monetary policy much less easy to predict.
Is it even possible to unwind the balance sheets?
Oh, it's certainly possible. You just have to sell the assets.
Yeah. Okay.
But of course, holders of those assets don't want the Fed selling large quantities, depressing the price. So there is resistance to a return to normalcy through the vested interests that have been created.
There was a moment in American history, it's called the Volcker shock. This is where a running inflation was cut, and of course met with high political resistance, at least from the American population. Is a move like that from the American central bank in the near future likely, or would you say this was a special moment in history we cannot repeat today?
Well, it was special in the sense that we had had several years of double-digit inflation, which was very unpopular, which the president at that time, Jimmy Carter, realized was going to doom his chances of being reelected. And of course, he wasn't reelected. But he understood the problem and chose Paul Volcker because Volcker had a reputation as an inflation hawk. Volcker had been a member of the Federal Open Market Committee, the Monetary Policy Committee, as the president of the Federal Reserve Bank of New York. And to his credit, Carter apparently told Volcker, you know, do what it takes. And Volcker said, there's going to be some pain. And Carter said, go ahead. And there was some pain because when you're trying to disinflate and the public is skeptical, then wage demands are not moderated and price demands are not moderated. You get unsold labor and unsold goods. And it was a severe recession. It's sometimes called the Reagan recession because Reagan took office in the middle of it. But Reagan also told Volcker to stay the course. And they finally brought inflation down to more reasonable numbers. Is there the political will to do that now? I don't see it from the Trump administration. Trump is claiming that we already have eliminated inflation. It's practically zero, he says recently.
Practically, yeah.
Even though it's 3% when the target is 2%.
And in the ECB, we have maybe a similar problem ahead of us. And will then the central bankers be determined to cut inflation, or will they try to inflate the debts away?
I think there's one big difference today compared to the end of the 1970s. At the end of the 1970s, we had a strongly decreased government debt in terms of GDP. And therefore, it was much easier to lift interest rates, because if you lift interest rates, of course, also long-term interest rates will increase, and therefore the debt burden for the governments increase. And today we have much, much higher debt levels. We have also prepared a slide here showing the debt levels of different countries. And the debt level is very high in Japan, 235% of GDP, which is only possible because the Bank of Japan has bought a very large share of the outstanding government debt. But it's also high in the United States, going over 120% of GDP. And it's and it's also very high in some southern European countries, being member of the euro area. France 130%, with a budget deficit being out of control. The government in France is not able anymore to control the government deficit. And there's also Italy with 135% of the government debt out of GDP. And of course, if the ECB would now lift interest rates, there would be serious trouble here concerning the interest rate burden of 7 European governments, but also concerning the sustainability of debt in Southern Europe. There would be a very strong threat for the stability of the euro. The euro could break apart. And therefore, the European Central Bank has introduced the so-called transmission protection instrument, saying if the interest rates of some euro area countries are increasing too much, the ECB is allowed to buy in a preferred way the government bonds of these countries, and that's already signaling that the ECB would expect that if the interest rate level is increasing too much, a new euro crisis would be ahead. So in my assessment, a very large probability or very low probability that the ECB will finish its relative loose monetary policy.
Talking about monetary policy or the monetary institutions in general, we kind of always have this assumption that the fiat currency central bank system will always go on, and there will be the next crisis and the next inflation and the next reform, but there will be no fundamental change. But then again, we have very interesting ideas, innovations, like the Bitcoin, for example, just showing a very different way of how money can be organized. You are the expert for free banking, and you thought about money in a very general way. How do you see current institutions, and how do you see the idea of a fundamental reform organizing money in a completely different way?
So my most recent book was called Better Money, Gold, Fiat, or Bitcoin. And the emphasis there is on the choice that we face among monetary standards. And in the ECB and in the United States, we will be the last to reform our monetary systems because our currencies are widely accepted. But in the rest of the world, it's a very live choice whether to stick with the fiat money issued by the domestic central bank or switch to something more reliable. And in Latin America, it's the dollar that the citizens of the economy switch to. And so you have bottom-up dollarization, not as a policy choice, but as a response of the households to the high inflation in the local currency. And that faces the national government with a choice whether to bow to the verdict of the market that nobody wants their currency, or to impose some kind of financial repression that stops the dollarization process. We've had a few countries officially switch to the US dollar, Ecuador, El Salvador, and there was talk about it in Argentina. And I think it's still on the table. Milei, when he ran for president, talked about his goal being to legalize the use of dollars, put the government on a dollar standard, put taxes on a dollar standard, and retire the Argentine peso and shut down the central bank. For political reasons, I guess it hasn't happened yet, but it's very much a live issue. So this kind of choice among fundamental monetary institutions goes on in many countries. And admittedly, it's a substitution, or would be a substitution in Argentina, of one fiat money for another, but the dollar is certainly more reliable than the Argentine peso, even if the dollar is not as reliable as it might be, not as reliable as the gold standard was historically.
Talking about the gold standard.
It's difficult to imagine a switch back to a gold standard. National governments are not going to be eager to do it, especially heavily indebted governments, because it puts real discipline on them, doesn't enable them to monetize deficits anymore. So it's going to have to come from the bottom up. I mean, if inflation gets bad enough, people will demand more fundamental reform. In a way, when the European Central Bank Constitution was created, I thought, well, this is the last great hope of fiat money, because here's an explicit constitution that says there's one goal, and the one goal is price stability. So if they actually do that, that will establish that fiat money can be issued responsibly. Well, it didn't last very long.
Gunther, do you see a different monetary system in Europe, or do you see a reorganization of the constitutional principle of the central bank?
Yeah, it's hard to expect. We have a highly politicized central bank in Europe. We have rising pressure within the euro because the euro, in a way, is not a complete currency system, because in the United States you have a common central bank and you have a common Ministry of Finance. But here the euro area is incomplete in the sense that we have a common currency for 20 countries out of 27 EU member states, but we have no common fiscal policies, and in a heterogeneous economic area, and the euro area remains very heterogeneous from the very beginning. We have uncoordinated business cycles which contributed to the European financial and debt crisis. In order to complete this currency area, we would need a common fiscal policy in Europe. So all citizens in the euro area paying interest, paying taxes, and paying social security contributions to Brussels, and the common Ministry of Finance in Brussels redistributing the funds across the whole euro area countries. And that's at the current state very unlikely to happen, because every country is concerned that the redistribution of funds would be at the benefit of other countries and not at the benefit of your own country. So the euro area is very likely to remain incomplete, but the heterogeneity within the euro area is increasing, and so the only way for the European Central Bank is to keep the euro area together by increasing money supply, by buying assets of highly indebted countries. And as we know, the most important stability anchor of the euro area was Germany. We have also seen on the slide the debt level of Germany. It's still substantially lower than the debt level of France, Italy, Spain and Portugal, but now the Germans have decided that it doesn't make sense to be the only country with solid public finance in the euro area, and have decided to increase public debt very strongly as well. And therefore the last stability anchor of the euro area is likely to be lost. And that is a clear indication that also the inflation level in the euro area is likely to strongly increase.
As you said, in Argentina, if you get rid of the central bank, you have the US dollar.
That's right.
If you get rid of the central bank in the USA, what do you have?
Well, you'd have to have a different monetary standard, and I think the most plausible candidate would be a return to the gold standard, but I don't see much political support for that now. And I think as long as inflation stays in single digits, it would be difficult to organize a majority coalition to switch back to a commodity standard. But it's good to understand how the gold standard worked, so that if we need to, if we switch to a plan B, we will understand what we're getting into and what institutions are necessary to support it. This is something Milton Friedman said about the switch from fixed exchange rates under Bretton Woods to floating exchange rates. It's necessary to think about it so that when a crisis happens, the ideas have already been, debugged and discussed. I don't think too many of my fellow economists think that this is anything they need to be concerned about, but I urge them to, understand the alternatives to fiat money, so that we're in a better position when a crisis comes, and we can understand better what's happening in countries that face this live choice because their domestic currency is experiencing 15, 20, 25% inflation. Then the public does get prepared to switch to a different currency.
What do you think of the idea of private money without a common standard, just the money, private money building up in competition?
Well, so Bitcoin would be an example of a would-be private money, a could-be or potential private money. It isn't there yet. that is, it's not a commonly accepted medium of exchange. It used to be the commonly accepted medium of exchange in cryptocurrency markets where people bought and sold Ripple and Ether, but that has actually been displaced by US dollar tether. So even in cryptocurrency markets, traders wanted a medium of exchange that was less volatile than Bitcoin. Bitcoin was created with that potential. I don't think it's a very plausible monetary standard because the way it's designed makes the purchasing power volatile, or the relative price of Bitcoin volatile. There's no supply response at any horizon to changes in demand. So changes in demand are fully reflected in changes in price, not in any changes in quantity that would moderate changes in price, unlike the classical gold standard. Now, we're not done with crypto experimentation. There are other projects being worked on right now. I'm a consultant of one of them, which trying to think about a different supply mechanism than Bitcoin's fixed supply, which would provide greater purchasing power stability to a cryptocurrency. And if it were seen as more reliable than the euro or the dollar, then it would stand a chance of being adopted.
But if you can change the quantity, you have again the problem of who decides how much quantity you need.
The key to making the quantity adjustment constrained is to put it in the source code, make it a program.
As a rule. Yeah.
So there's a rule, that's right. So it comes back to the point I made earlier. It's more important what the rule is than how independent the issuer of money is, especially if independence means nobody holds you accountable. So yeah, that would be part of the design. The supply responses are dictated by the program. So years ago, an economist named Bennett McCallum proposed a rule for a fiat money system in which he built on Milton Friedman's idea of a fixed money growth rule and said, we can build some feedback into the rule and still have it be a rule. So the central bank it's told by the rule how much to increase the monetary base each month based on what's happening to real output and what's happening to velocity. But it's not at their discretion. And yet it helps maintain price stability better in a world where velocity is volatile and real output is volatile than a fixed money growth rule does.
If we see the price changes of Bitcoin and gold in the last weeks, you can say there's a gold horse price rise, and it reflects the distrust of fiat money, but we don't see a price rise in Bitcoin so much. How do you explain that the people going to gold at the end of the day?
Well, so when Bitcoin became a popular investment, it was often compared to a digital gold, meaning it was an inflation hedge and a tail risk hedge that people would move into when they were worried about what was happening with the dollar or the euro. It seems to have been decoupled, so the prices of gold and Bitcoin are not correlated anymore, if they ever were much correlated. So I'm not quite sure how to explain why Bitcoin has not enjoyed the same rise in price that gold has in the past months, except that some central banks are acquiring gold and not Bitcoin, namely Central Bank of China and the Reserve Bank of India. And central banks today own more gold than they did 10, 20 years ago, even though nobody's on a gold standard. So for them, it seems to be a hedge against the falling purchasing power of the dollar.
The founding idea of Bitcoin was getting rid of the banking industry.
I wouldn't say that. I would say it was getting rid of central banks.
Okay.
So in this discussion so I've studied this for the book I mentioned, Better Money. If you look at the online discussions among the cypherpunks, there's the community that Bitcoin came out of, they were saying, well, this currency we're creating, Bitcoin, is going to be like a base money or a settlement money, but we can build a banking system on top of it. And Hal Finney, who is widely suspected to be at least part of Satoshi Nakamoto, cited George Selgin's book, The Theory of Free Banking, and said, this is how we can have a self-regulating banking system on top of the base layer of Bitcoin.
Gunther, what do you think of Bitcoin and the central bank, sorry, not the central bank, the digital currency idea?
I would say Bitcoin and gold have two things in common. Both of them have all the free functions of money. Yeah, you can express the value of things in both gold and Bitcoin. Bitcoin is not only Bitcoin, it's also a subunit Satoshis, and you could express the value of goods in Satoshis. They both are a store of value because the supply is limited. It's even more limited in the case of Bitcoin than in the case of gold, because you can still produce a certain amount of gold, and you can also use it as a medium of exchange. Bitcoin much more than currently gold, because it's very difficult to go in the shop and buy with a little gold coin, because the gold price has strongly increased, but you can make very easily transactions in terms of Bitcoin, at least theoretically. Now, both Bitcoin and gold, the price has strongly increased in terms of fiat currencies, all fiat currencies, dollar, euro, even Swiss franc, and so on. And that clearly sees that the trust in Bitcoin and gold is larger than in the fiat currencies. But what was puzzling in the last month was that gold is continued to go up. Why? And that's nicely also here shown on the slide, while the price of Bitcoin was declining. So we're going into opposite directions. And one of hypotheses could be that in specific the trust in the dollar as a global currency continues to decline. Central banks which have previously held dollars in the balance sheets, like the Central Bank of China, People's Bank of China, Central Bank of Russia, Central Bank of Turkey, and so on, they have started to substitute dollar by gold, which is again a sign of rising distrust in the dollar as leading global currency. But maybe we have gone too far. Maybe, meanwhile, the dollar is stabilizing, at least, if we compare the monetary policies of the FED, the ECB, and the Bank of Japan. We could take a look on the latest key interest rates. The Federal Reserve Bank was much more hesitant in cutting interest rates than the Euro system, when the European Central Bank and the Bank of Japan, which is anyway no power to increase interest rates anymore. And in addition, the central bank balance sheet in terms of GDP is much smaller than in the case of the Euro system and the United States. And now what is new in my interpretation is not the statements of Donald Trump concerning monetary policy, because he seems to push the Fed to cut interest rates again. The finance minister of the United States, Scott Bessent, he makes a lot of criticism about the past monetary policy of the Fed, and he also has stressed that he wants the Federal Reserve to return to a monetary policy which is more stronger focused on the original goals, in specific of keeping inflation low, and that could be first signs of a kind of monetary stabilization in the United States. And I think the United States have also a motivation of stabilizing the currency. because they have the exorbitant privilege of the dollar being the key international currency. And as long as other central banks hold dollars, that creates additional potential to increase expenditure in the United States. And if this exorbitant privilege of a dollar would be lost, that would be a very serious situation for government finance in the United States. And if you look on the program of the Republicans in the last run-up to the presidential elections, it's clearly mentioned they want to strengthen the status of the dollar as a leading international currency again. And therefore, we are already in a situation where, at least very slowly, the administration of Trump is trying to stabilize the dollar. That's how I read
the statements of Scott.
I guess I do put more weight on what Trump says and how he lobbies the Fed and how he controls the appointment process. He doesn't seem to be running his candidates for appointment to the Fed through Scott Bessent. For better or worse, but this is a problem that the international use of the dollar is undermined by unreliability of the dollar, and it would be in the interests of U.S. Taxpayers to have the rest of the world still happy to buy U.S. Treasuries at low interest rates.
And not only the taxpayer, also the government.
Yes, of course.
Okay, just...
I mean, let me add, the BRICS nations have been talking explicitly about trying to replace the dollar with something else. They don't really have a viable candidate within their own ranks. And so what else does that leave? Well, the euro, but they don't want to adopt the euro either. I mean, there's some remote possibility that they will finally figure out that if they want a non-political currency whose supply no government controls, that points to gold. And so they've started, a few central banks have started increasing their gold holdings.
Just to sum up, let's assume you were the central bank president, so the chairman of the Fed and the president of the ECB. How would you conduct monetary policy and maybe monetary reforms if you have all opportunities at your desk?
I don't want the job. I don't envy the person who holds the job, but I think it would be important to establish a single-minded, even fanatical commitment to a rule, to either a price level path or a nominal GDP path, and stick with it through all kinds of adverse events, and not worry about allocating credit among different sectors of the financial market. Let the market process sort out which institutions are viable and which firms are not viable. Don't try to make housing finance artificially cheap, all those sort of distractions from the Fed's mission. And don't try to massage or worry about the unemployment rate and real output. Those will sort themselves out if you have a credible nominal anchor.
Gunther.
Yeah, it's widely known that I'm convinced about the former central bank model of Deutsche Bundesbank. Deutsche Bundesbank was independent, and within Deutsche Bundesbank there was a culture of stability. So everybody working for Deutsche Bundesbank was convinced that a stable currency is at the benefit of the German people. And by the way, the German people were convinced as well. They really appreciated the monetary policy stance of Deutsche Bundesbank. And therefore, I would take the necessary decisions to retransform the monetary policy of a European central bank into what was practiced by Deutsche Bundesbank, and In this context, in my view, it's not enough to only observe the official index of consumer price inflation in the euro area as an indication for price stability. We would need a much broader view about inflationary pressure as reflected in rising real estate prices, rising gold prices, or rising Bitcoin prices, and also return to a more serious assessment of monetary growth, of money growth, as an indication for future inflationary pressure in a broader sense.
At the end of the day, all these national central banks were in a monetary competition against each other.
Previous to the euro.
Yes.
Yeah? And we have to be aware that as long as we had a currency competition previous to the euro, this was very fruitful for all people in Europe because German Bundesbank had a stability-oriented monetary policy. There was a different attitude in France, Italy, and Spain, and that's why the German mark appreciated against the French franc and the Italian lira and other southern European currencies, and that made German products more expensive in other European countries. And there was no support by the Deutsche Bundesbank against this loss of competitiveness. And therefore, the German enterprises, the German corporations were forced to deal with these rising prices of German products in other countries by increasing efficiency and by producing products which were less price sensitive on the international markets. And that generated very large productivity gains, not only in Germany, but the productivity gains generated in Germany by the currency competition could be redistributed in Germany via higher wages or more social security, but it was also redistributed to other European countries. And therefore, everybody was better off. And this period we should keep in mind when we talk about the costs and benefits of a common European currency.
I think the Swiss central bank is maybe the last place where that sort of mentality still prevails, or at least until recently.
Yes, they always allow for a gradual appreciation of Swiss franc. And that is...
Despite the screams of exporters.
Yes, despite the screams of exporters, and that contributes to rising productivity and indeed rising industrial production in Switzerland, whereas industrial production in Germany strongly is declining since years.
What's your perspective on the future of the euro from an American perspective?
Oh, well, like I said, when the euro was founded, I thought, okay, let's see if they're serious. And some years ago, I think it was actually in 2000 or 2001, just after the euro had launched, Otmar Issing was invited to give a talk at the Institute of Economic Affairs in London, and he sort of proclaimed victory. He says, now we have the ideal central bank, and everything will be great. And I was invited to write a comment on his talk. And in my comment, I said, let's not jump the gun. Let's see how it actually works out in practice, whether this commitment will actually be honored. And I think my pessimism was justified. It's turned out to be kind of a very much like the Federal Reserve System in being concerned about being distracted by other goals, not ignoring real variables over which it has control, but thinking that being subject to, Phillips curve thinking that we can't let inflation fall because that will raise unemployment, even when inflation is above the target. And then you have the additional problem of the national government's debt problems being of concern to the ECB when they really shouldn't be. At least the Federal Reserve System doesn't worry about the debts of the state of California. California could default, and in principle, at least, the Fed would let that happen. Now, if push came to shove, I guess we would see what would actually happen. But that's been their attitude all along. We don't worry about the fiscal situation of the 50 states. And so you can have a currency union without worrying about the fiscal situation. But if you are if political pressures force the central bank to take that into account, then you either have to go all the way to having a common fiscal policy, or you have to recommit to letting each nation state's fiscal situation take care of itself or rise and fall based on the behavior of the nation states. But being somewhere in the middle is not a stable equilibrium.
Thank you very much. Thank you, Gunther. Thank you, Larry. I think this was a very inspiring talk, especially I think it's very interesting to think of alternative monetary standards, even though we expect that the current fiat standard will last longer than we may think. Thank you very much for your attention and see you the next time. Bye.